So the division of labor with the Giovanni is that I will focus on the fiscal and monetary story and on the overall political discussion, and you will focus more on the industrial and innovation policy. Actually, I have a final piece of evidence which introduces nicely what the Giovanni will discuss. As we are moving, you have already been discussing in previous events the economic ideas. The focus here is more on policies, and so I found this very nice text which combines ideas and policies. And this text is the text of the famous Delors committee that in 1989, before the fall of the Berlin Wall, set the trajectory of evolution of the European integration, which, however, was a completely wrong trajectory, both in terms of ideas and disastrous in terms of policy implication. I will be very sort of outspoken so we can have an open discussion in. By the way, these who were in this committee, only in the 80s, you know, there was the European Monetary Union, the European Monetary System, okay, which was a loose combination of exchange rate agreements with a little bit of something like an international, supranational institution which was supposed to help balance the fluctuation of exchange rates, which did not really work. And so, at the time, concerns about instability of exchange rates was dominant. Who is in charge of the exchange rates? Central bankers. So Delors, who was a strong European federalist, a socialist, a French socialist, rather progressive in a number of fields, made the terrible mistake of creating a committee made only of central bankers. So we had 12 or 15, I can't remember exactly, central bankers, and for Italy there was Carlo, and on top of it there was Padre Schioppa, who was the secretary of the committee. Both have been economics minister of center-left governments, and both have made terrible policy decisions, which whose price we are still paying now. So why this is interesting? Because they were a very bright group, and they really understood what was happening and the trajectory of that they were taking for Europe. The trajectory is the following. European integration is defined as complete freedom of movement for people, goods, services, and capital, as well as irrevocably fixed exchange rates moving towards a single currency. Okay. Clearly, if we go towards a single currency, which was the beginning of the discussion at the time, we need much more policy coordination in a range of other fields. But the first immediate decision that was taken after 89 was the full liberalization of capital movements. Okay? Full liberalization of capital movements. This is clearly the result of what? In 10 years before, there was the election of Thatcher in Britain and Reagan in the US. As you have seen from the UK election results, the legacy of the Thatcher victory is still with us and will continue to be with us for another 5 years. So there is a very strong past dependency in the evolution of the UK. And this was the beginning of what we can call the neoliberal age. This neoliberal age was founded on the idea that the market would return to be dominant in organizing economic activities, and that the liberalization of capital movements that in the previous 4 decades had been very strongly controlled by national governments, the rapid growth of the post-war decades in Europe depended on the ability of states to prevent freedom of capital movements and pushing, on the one hand, the capitals to be reinvested in the real economy of the country, and secondly, keeping low the returns on capital, okay, and containing, therefore, the power of finance. this was broken by Margaret Thatcher with the Big Bang of the City of London in 83-84, and of course was broken with the Reagan changes in deregulation of financial activities. So Europe bought this idea that liberalization of capital movements was going to be an important step forward of European integration, because goods had been increasingly liberalized. In these years there was the discussion of the project of the single European market, which further liberalized trade in goods and services, but capital was still with some degree of national control. And so the emphasis was, let's do like the UK and the US are doing, and liberalize capital movement, and on top of this, deregulate some finance. Of course, they were intelligent, and they said, if we liberalize capital movements, we will have exchange rate problems. This was 1st July 1990. In 2 years' time, July 1992, total collapse of the European exchange rate system. Italy, UK, and Spain they have to devalue by 30% the currency. Okay, the Maastricht Treaty had been signed a few months ago, and the idea that you could have a liberalization of capital flows and a soft model of exchange rate agreement was proven to be totally unrealistic, because if you have a capital liberalization, capitals speculate against weak currencies, no? And of course governments and central banks don't have the power to confront huge capital flows against one particular currency. This has two lessons. Well, first of all, one of the main actor in this attack against European currency was George Soros, who made a lot of money, became a millionaire, and has since tried to become, to sort of repent and found the Institute for New Economic Thinking, where some of these critical ideas have been emerging. I was at a conference in Paris after Easter. I will tell you a little about that. But basically what happened was that, so they understood that, but they hoped that this would become a further push towards a monetary integration, because you remember in these years the Germans were very rigidly against giving up on the Deutsche Mark, and the French were very afraid on, for instance, in the meantime there was the fall of the Berlin Wall, so the idea of the German unification was a major political question. So how can we contain Germany? This is another issue which we totally failed. So we now have a German power which is totally uncontrolled, and this is also the result of the mistake of this period. So they understood that this was a problem, but of course we went exactly to this crash. Policy coordination was expected, but the overall objectives were meant to be price stability, which of course became the objective number one in the statute of the European Central Bank, balanced growth, which is not clear what does it mean, converging standards of living, which happened to some extent for new member states, high employment, which was completely forgotten, and external equilibrium, which is exactly the opposite of what happened. You know that today, no, Germany has a surplus of the trade balance over GDP, which is way higher than China, and this is at the root of the crisis of the dynamics within European policies. Finally, this, of course, they understood, the Law Committee understood that giving up exchange rates would remove a tool for adjusting country imbalances, and the adjustment would have to be moved to the structure of the economy. What is the structure of the economy? In theory, the sectoral composition, the productivity dynamics, the cost dynamics, but more especially wage flexibility and labor mobility. that is exactly what the Troika is saying today to Greece, Spain, Portugal, Italy, and so on. You have to have internal devaluation, because you cannot have a devaluation of the currency, you devalue the costs, and the costs are wages. Okay? So, the story of 25, 26 years of European integration is all in that document, in few lines, in 2 pages of that document. They already understood that the outcome of this trajectory of European integration would be a downward pressure on wages, because no other possibility of adjustment would be possible. Okay? So this is quite interesting, rarely happens. So what they say is that economic and monetary union, of course, the report charted the trajectory that led to the Maastricht Treaty, okay, and the shaped the way of the creation of the European Monetary Union and the Euro. This would be the final result of the process of progressive economic integration in Europe. What does that mean? Okay, are we talking about a process of economic integration? Are we talking about a political project? Let's look at this in turn. Economic project. In this period, we had a single market, 1993, okay, capital liberalization. What was the economic theory behind this? You all know, no? Mainstream economic theory would say we have integration of trade flows, of capital flows. What happens with integration? Increasing efficiency, okay? Reduction of transaction cost. We had incredible false data on the benefits from single market in terms of welfare, reduction of prices, improvement of living standards, and so on. Convergence of production systems, because the capital flows from capital-rich country to capital-poor country. In this period, we had, of course, southern European countries being integrated into the European Union, and then we had additional countries. So the idea was that these countries would be able to catch up thanks to the flow of capital coming from the center, from big countries, and of course, the learning processes, technology transfers, and so on. So the idea was that these dynamics and the stability of currency with a single currency would allow these countries to converge, in particular on the 5 Maastricht criteria. The 5 Maastricht criteria were, of course, the convergence in terms of exchange rates and the abandonment of national currency, and then 4 basically financial criteria: interest rates, inflation, public deficit, and public debt. Okay, with the idea that public debt was basically crowding out capital investment in aiming at private productive activities. So the idea, the theory, the mainstream theory, neoclassical theory would say on economic grounds that's a perfect idea. Integration, economies of scale, economies of scope, less transaction cost, catching up processes, stability of currencies. Okay? By the way, let's underline that the stability of currency, as a matter of fact, at the time was an important point. We have forgotten about that. Okay? So a lot of people now say, let's return to national currency. Okay, if you have a national currency and your national currency is not the currency of a big economy, this is a clear target for speculation. So if having a national currency does not mean that you are more powerful in your economic policy tools. It means that you are more you have an additional tool for adjustment, but you are also very vulnerable when in the context of international capital freedom movement. Unless you control capital movements, having national currency risks to be a big problem. And when Italy had the devaluation in 1992 of 30%, this was the start of the end, the beginning of the end. Italy stopped growing in terms of significant growth rate of GDP, of a significant growth rate of productivity. Real income stopped growing. A PhD student of mine has done an estimate of the alternative measure to GDP, which includes correction for inequality, environmental damage, and so on. And 1992 is the year from when Italy stops growing at all, okay? And then from the last years we go down. So 1992 is really a key, and by the way, inequality in Italy jumped exactly in 1992 from all the available data of different studies. So 1992 is a key point, and 1992 is a crisis produced by the liberalization of capital movements and the vulnerability of Italy's currency. So this is an interesting lecture. And anyway, in terms of economic progress, what we are seeing now as an effect of the crisis, we will see that the crisis has made everything more visible and more dramatic. But the failure of this economic integration has been accumulating for a long time. So the mainstream expectation on what would happen with this type of economic integration were not experienced for a lot of European countries, especially Southern European countries, also before the explosion of the crisis. So in a way, in terms of economic progress, this was a false promise. Okay, what we experience now, and we will see in a moment, is a huge divergence. Was this a political project? Yes, it was a political project. This is something that our Anglo-Saxon friends do not understand at all. If you go back to what was written in 2008, 9, and 10 by a lot of American economists, Urbino and others, everybody was saying that the euro is going to collapse because it's not an optimal currency area, because the imbalances are too high, because there is no political authority able to deal with the crisis. So you can go back and read 10 Nobel Prize or almost Nobel Prize economists predicting, expecting on the basis of an economic argument that the Eurozone was going to collapse. The Eurozone did not collapse. Why? Because non-European, non-continental European underestimate the fact that today, 70 years ago, there was the end of the Second World War, and this meant something for the political culture of Europe. And the political idea of the political integration of Europe is something which is more important than just the theory of optimal currency areas. So, never underestimate the importance of politics. And the fact today, with the present arrangements, the Greeks are being destroyed. Italy is being destroyed. The Germans perceive, German public opinion perceives that they are suffering. That's, we will discuss that. But everybody is so afraid to change the current arrangements because they understand that a major institutional change risks to lose a lot of political capital that has been invested by at least 2 generations of Europeans in the project of European integration. So this is not something that has to be evaluated, in my view, with the rough tool of economists, in the sense of I'm better off in terms of GDP growth or in terms of relative position, because this, the political dimension is really what explains the fact that in spite of all a set of disastrous economic dynamics that we will see shortly, the political project of European integration is still what keeps a lot of things together. However, in political terms, again, this trajectory was a total disaster, because this was expected, this economic integration was expected to be matched by the creation of European constitution, okay, with a political legitimation of a supranational set of institutions, new forms of democratic processes, including greater role of the European Parliament and so on, whereby greater democratic legitimacy could be introduced into these dynamics, which are basically technocratic dynamics. Either we leave the market rule, or we have some technocrats in the European Central Bank, or in the European Commission dealing with some aspects. The referendums in France and in the Netherlands blocked the project of European Constitution, and so we have been left with a one-leg process of integration without any significant political process integrating this aspect. if you don't have written rules, what happens? There are informal rules, okay? If we do not decide who is the chair of a meeting among us, the de facto chair is the one who is more aggressive, more determined, and so on. And so this meant that in the middle of the crisis, Germany has been taking the de facto leadership of the European Union outside of any political framework. So, in this way, the European integration dynamics can hardly be explained on pure economic grounds and was a failed political project. So how should we understand this? My proposal is to conceptualize European integration and in particular the creation of the euro as a neoliberal project. In other words, this is the way at European level there was the reinterpretation in the European context of what the neoliberal age has been producing in the US and in the UK. That is, the project of reversing the convergence of income, the greater equality, the greater role of the state, the rapid growth of GDP per capita, the growth of the wage share in GDP, and the important role of the state in directing economic activities. That was what happened in the 50s, in the 60s and 70s, especially in continental Europe. The combination between Fordist production, Keynesian macroeconomic policies, and the development of the welfare state. This is what made continental Europe rich, but also made continental Europe equal, and what made the working class in Europe powerful. Okay? And of course, this was inconvenient for a capital which was increasingly unable to continue to have high returns on investment, and who was increasingly tempted to shift to the US and UK model of growing power of finance. So the ingredient of the liberal projects since 1980 has been saying that markets rule. Markets are what are needed, markets are more efficient, and state decision in the economy should be reduced. Finance is where the show is, where the money is, where profits are. Okay, the emerging sector is finance. So everyone should pay more attention to developing financial activities, and the whole, for instance, monetary policy should be geared to a growing financialization of the economy. This goes hand in hand with deregulation of financial rules. For instance, since one of the lessons of the Great Depression was the Glass-Steagall Act in the US, breaking, introducing the rigid division between commercial banks, where we have our banking accounts, and the investment banks, which can make speculation. And of course, this was a division which was weakened progressively until the total repeal in the US during the presidency of Clinton, and of course the same has happened elsewhere. Broadly, in labor markets, in distributional dimensions, inequality dimensions, the power of capital has been restored by a variety of tools, weakening the unions, cutting the welfare states, segmenting the labor market, and so on, and labor has been losing ground on a lot of activity, of dimension. More broadly, more generally, less politics meant less public expenditure, less privatization of public activities, reduction of services delivered to citizens as social rights, not as market activities, okay? And therefore, an entirely different vision of not just of the functioning of the economy, but also the relation between the economy, society, and politics. And this is what we can call the neoliberal project. In a way, the trajectory of European integration was the embodiment in the European context, which is different institutionally from the Anglo-Saxon context, the US context in particular, because of this. These some pieces of evidence. This is from the Global Wage Report of the ILO recently published. The adjusted labor income share in European countries have been falling dramatically since 1991. This is exactly the year of this European integration. But if you go back to 1980, you see that the fall is even steeper. So the age of neoliberalism was about taking money away from labor and give it to capital. Okay? And this is something very clear. Italy, by the way, is incredibly bad. Adjusted means adjusted for self-employment. Okay? Italy, as you know, is a country where a lot of people earn income as self-employed, more than in other countries. But apparently, these data are already adjusted with the fact that the plumber in Italy is self-employed and not an employee of a plumbing company. Okay? So Italy, as you see, there are different dynamics, but on the whole, that's the story about the labor share.
So United States are the highest share.
So, well, yes. The US, there is the trick here that the top managers are counted as labor income. In a lot of the data on inequality and the role of wage in the US includes the football stars, the singers, the actors, the top managers. The part of the remuneration which is paid as compensation of work is included as wage. So in the US we have this paradox of the wage share, which sometimes increasing, but that's the result of the top 1% or 5% of the Americans. So and there is actually an interesting paper by Villazonic who shows that if you count the remuneration which is stock-based, for instance, top manager, I am a top manager, my compensation is made by basically 80% by stock options and other compensation which is linked to finance, not linked to my wage. And therefore, if we check for this aspect, we have an entirely different story. The known 1% wage dynamics in the US is different from that.
That is, now you're including those packages in the wage?
Sorry?
This graph you're including
Yes.
those packages in the wage?
No, this is including, I think. This data, this is the rise, you see, this is the financial boom, okay? And this is the rise of the 10% earning these extremely high compensations.
So now they are losing. I don't understand this point. Now they are losing a lot. Now United States below France. It's the red one, sorry, it was from
Yes,
US.
and very much below UK.
And very much below UK, so now the story is there.
Okay, let's, we can see that for the opposite with the capital share anyway. What we tend to see is that when there is a crisis, in the short term, what happens is that profits, which are the residual, fall, okay, in the short term. So in 2009, in a lot of countries, you have a temporary rise in the share of the wage because the profits have been hit by the recession. Okay, but then the trend more or less continues in most countries. And clearly, if you have a period of prolonged recession, you may have different dynamics. So for the very recent years, clearly there is no overall trend. But what we are interested in is in the long-term story. And this is the Piketty's story from the database on the Piketty work, on the capital share again in all countries. Italy again stands with extremely high value of the capital share. These data, for my understanding, are not adjusted for self-employment, so this can be really overestimating the Italian case. But again, what you see is that the capital share falls everywhere, every time there is a short-term recession. So the recession of 82, the recession of 92, the recession of 2001, the recession of 2009. These are all periods where there's a temporary fall in the capital share, because of course profits are hit by the fall of economic activity, but then you see that the trend is not really changed. So there is a long-term trend of increasing the power of capital, and the share has been going up quite substantially, because here in 75, before neoliberalism, no, we had a share ranging from 15 to 25, and now we have everywhere a share above 25%. So this is a very fundamental element which tells us something about the overall balance of power in the economy and the overall logic of the model of accumulation. Of course, you may be familiar with other sources. This is again the Atkinson database on the top on inequality and the share that the richest 1%. These are data come from tax reports, okay, from tax declarations. We see that everyone with less increase in France, substantial increase in Germany, less increase in the Netherlands, substantial increase in Italy, extreme increases in the UK and the US, have been becoming countries with a very strong polarization of income. Okay? So we have clear beneficiaries of this dynamic. And one of the important mechanisms, this is again from the Global Wage Report of the ILO, one of the main mechanisms has been the fact that labor has not been able to have a wage increases in line with productivity growth. The idea, of course, is that if wages increase with the same rate of growth of productivity, the distribution between wages and profit does not change, because the cake is grows for both profit and wages at the same rate. What we have seen is that more or less the rate of growth has been half for wages and not at all increasing. Again, here we have the crisis. There is a temporary fall of output, but the trend continues. So that's quite interesting. This is for the 20 most developed economies. Clearly, Italy, unfortunately, is not going in this way with productivity. Italy is the worst performer in terms of productivity, but for the all-rich countries, we have these dynamics and wages which have been flat. Okay? So the story is that the dynamics of growth of the economy has been controlled. Good morning, Professor Dawson. Has been controlled by under this neoliberal project by a dynamics of financial growth, finance-driven growth, and technological change and globalization, global production systems which are behind these productivity increases, leaving aside the ability of labor to obtain the benefits which were associated to that. So these are, in my view, we can come back if you want more details, but this is what I can consider some stylized fact of the neoliberal age. Okay, so the redistribution from labor to capital, importance of finance, increasing inequality. So if this is the long-term story that shapes more or less the context, what has been the specificity of European integration from the fiscal and monetary dimensions? Of course, we have already said that there was the Maastricht Treaty in 1992 with the convergence focusing only on these variables related to financial aspects, no criteria for convergence, for instance, in trade balances. If there had been a criteria on that, of course, Germany could have not accumulated trade surpluses, destroying the demand in other countries. Or, of course, we could have had convergence criteria in a number of other productivity or innovation or employment dimensions. Clearly, there was this crazy role of the European Central Bank, which prevented the Central Bank to do what all central banks in the world since the beginning of history have been doing, that is, giving money to the political authority. everywhere in all historical experience, this is the fundamental role of the central bank in the creation of money under political sovereign. And the fact that the ECB that operates as a foreign central bank for individual countries is a fundamental mistake, and our American friends still cannot believe that we have been so stupid to do it this way. One other aspect which tends to be underestimated in recent debate is the international dimension of the story, because we focus on the intra-European aspects, but those who have been looking at international developments say that the euro was an important development in reducing the absolute power of the dollar as the only world currency. And of course, we should not forget that in this aspect, the euro has been a success. A very striking news in the New York Times 2 weeks ago was that Mexico launched an emission of bonds denominated in euro with a length of 100 years, at 4% interest rates. And investors went for it. It was sold in a moment. You know, Mexico has been a failed country, insolvent more than once. The euro could not exist next month. You can imagine what it would mean a bond in 100 years from now. So this tells you two things. First, the credibility of the euro on the global market is much greater than what we perceive. Secondly, that the finance is really crazy. Okay? Because how can you anticipate the value of a Mexican public debt 100 years from now? No? Okay. So it's, we'll say, not crazy, desperate for positive returns in a situation where most of the investment in public bonds give you negative returns. If you invest in Japanese, American, German, and most of the rich countries' bonds, you don't get any return, net return out of inflation. Okay. So this international dimension is important, should not be forgotten, and a lot of people outside of Europe are very happy that the euro exists because it provides a pluralism of currency regimes, and of course we are in a situation with China creating its own World Bank, more or less, a global Asian investment infrastructure bank where the US is not allowed to enter. So we have different signs of an emerging multipolar economic order, which is a very interesting sign. And so it would be very stupid for Europe to give up an important contribution to this multipolar dimension. Interestingly enough, the euro was a success from the viewpoint of financial markets. Immediately after the reversibility of the exchange rates and the introduction of the currency, interest rates, which in Italy were 15% and 1% or 2% in Germany, converged. Why they converged? Because the financial markets were perceived the creation of the European, the Eurozone, as basically the mutualization of debt and the convergence of the financial conditions in all areas. So the main benefits that all European countries, including us, had from this monetary integration was the fall of interest rates. Okay? So here comes Hans Werner Sinn, who was in Urbino last week. You know, Hans Werner Sinn is the worst of the worst, the most right-wing economist in Europe, the one who says that Germany is suffering from all these, that the Greeks will be kicked out and sent to Africa rather than be integrated in Europe. And so, he thinks that Draghi is a dangerous Marxist and Merkel a dangerous Keynesian. Okay, so his point was that he has a holiday house near Urbino. So there was the interest of inviting him to give a seminar. And we learn a lot because you see that really this type of right-wing economists are thinking like in 1910, 11, 15, Before so Keynes, it would be sort of mad at these arguments. These are really the arguments before the age of Keynes. He doesn't understand that demand matters in the economy. The other interesting thing he said, if Italy had used the savings from the reduced interest rates on public debt to repay the debt, Italy would have no debt now. Well, of course, the first objection we made was that, well, if you take the money and pay the debt, aggregate demand falls, public expenditure falls, the GDP is not the same as with the expenditure, so the ratio of debt to GDP does not decline as you would expect, because the GDP falls. And of course, but his point was that the opportunity of the prize for the Eurozone, for belonging to the Eurozone, was lost by Southern European countries because they did not took advantage of this element to put their house in order. Clearly what happened? Lower interest rates, booming public debt in Greece, and to a lesser extent in Italy, booming private debt in Spain and Ireland, bubbles in the real estate market, and a lot of car money, the surplus from the lack of convergence in trade from France and Germany being invested in the Southern Europe. So German banks buying Greek bonds or invest for holiday houses in Spain. Financial and real estate bubbles. Clearly, the idea that you have capital flows that can efficiently compensate for divergence is really inadequate, because you have the mounting of imbalance that sooner or later creates problems, and sooner or later bubbles burst. And this, of course, came with the US crisis of 2007, which was turned into different forms of crisis in Europe. So in Ireland we had a private crisis with the saving of banks. By the way, there was in Paris at the INET meeting, there was the governor of the Central Bank of Ireland who said, oh, we are fine, we are now back on track, we are now growing, the economy is growing. Well, yes, we made this little mistake of bailing out banks, which costed us 7% of GDP. So this is the interpretation of a financial crowd. Okay, so yeah, it was just a little present we gave to finance, which costed Ireland a few years of a deep recession and immigration, but besides that, we are now back with the same performances. So the way in which this was affecting Europe differed a lot, depending on the context and the policy decision. If you want, we can go deeper into this. Just to summarize the picture that is emerging with the effect of the crisis, is that Europe was without appropriate tool to deal with the crisis. At the time, there was no fund for intervening in the cases of countries which were basically insolvent, or banks which were basically insolvent. And of course, there was this whole set of wrong ideas. Okay? You could go along with the same neoliberal assumption, markets are efficient. Okay? There was just some excessive risk-taking by private investors. Okay? So the question becomes, how much should I punish the excessive risk-taker, or how much was the mistake made by the policy authority at the time? And so the problem is not this one. The problem is, how much do we want the neoliberal assumption to continue to rule our economy? That is, freedom of capital movement with no controls. By the way, even the IMF now says that capital market imbalances deserve some attention and some balancing. Secondly, the total lack of regulation of finance. Okay? The US is the only country which introduced a timid bill controlling for reducing some financial excesses. Of course, not too much, because Obama has been elected with a lot of money from Wall Street. Wall Street is running the treasury and is not at all happy with the regulation of finance. In Europe, there has been done nothing. We have been saving banks, all the failed banks have been bailed out in Europe, and there has been not a single decent policy change able to control the misdeeds of finance. So we still have all the wrong ideas. And what we got is that in this policy void, the big becomes powerful. And so we have a Europe run. If you think the way in which a policy problem was addressed in 2005, you would have had a meeting of the European Council, a big debate. German would have been very quiet in the way it would develop their arguments. Okay, now we have everyone expecting Germany to say whatever they want on anything in Europe, including Ukraine. Okay, so we have a situation where this is a very dangerous development, also for broader political questions. Finance has been untouched. We are stuck with these crazy austerity policies, which is really, if you want some of these details, of course, the fiscal you are familiar with the fiscal compact. Very briefly. The principle of the balanced budget, which is incredibly stupid, is written in all European constitution or constitutional law. I mean, it's just like saying in the constitution that the earth is the center of the universe and not the sun. Okay. Secondly, we from this year or next year, Italy and all the other countries will have to repay the excess of debt over 60% of GDP, which for Italy is 70%, 75% of GDP, over 20 years. Okay, so this means taking from the cake of Italian GDP a slice, about 10%, and giving it to creditors. And of course, everyone knows that if you take a big slice out of the available income, the country becomes poor, demand falls, GDP will fall, there will be not a stagnation, but a major depression. So this is total nonsense from all points of view. And, we have had 90% majorities in the Italian parliament voting this stuff and voting this changing the constitution. Moreover, an additional thing, when the European Union allows Italy to have a particular budget, particular government budget, the expectations on the sustainability of the budget deficit is calculated on on deficit corrected for the cycle. Okay, the correction for the cycle in the case of Italy assumes a structural employment of 12%, not a structural employment of 6%. And this was a mess made by some technocrats of the Treasury. And this means in practice that if we had not this crazy detail written in the fiscal agreements, Italy could have a much larger deficit today, because now we are in a phase of recession, and so adjusted for the cycle, we could have been more generous in our fiscal policy.
And not 12% is the equilibrium now.
Exactly, the NAVRU is 12%. So we are really in a situation where basically the Euro says Italy is a country which, I mean, a third world country where there is this type of, is useless to try to reduce unemployment below that level. And of course these points are made not by far leftists, are made now by Bassanini or bankers and people in the Treasury. Pardon is realizing this, but apparently nobody is able to change what has been agreed. People in Brussels, our friends in the Commission, were telling this us 5 years ago. Now we are in a situation where this is really binding. So we cannot really get rid of this, and this is going to really strangle all kinds of prospects. What we are stuck, therefore, with the depression in the south of Europe and stagnation in the north, a structural divergence, and clearly the question is how long can we go on in this way? So the situation is becoming really difficult also because there is no real debate on this making explicit these terms, because all the debate is made about the Greek case, the details on the banking union, on arrangements within the bank regulation and so on, but the sort of the basic argument about the importance of demand, the importance of public intervention in the face of depression is totally lost. On the contrary, the right wing in German-speaking countries is really worsening, looking at the same picture, saying, okay, this is unsustainable, but we should leave market operate even more, so therefore wage devaluation is the only thing to do. The scene was saying every country can be competitive, but Greece should really just reduce wages. It doesn't matter, it doesn't understand that Greece is not producing anything except for olives and tourism. So even if they reduce wages, they are not going to export anything more, okay? Because there is no production. Greece accounts for 1% of Europe's industrial production. But this is the level of stupidity of the debate, which is, and it seems impossible to escape. So what is the escape? Clearly, breaking the Eurozone could be a possibility. Clearly that Sin and other right-wingers argue openly for this. But again, as we said before, there is a political context which is often underestimated by our Anglo-Saxon friends in particular, and it will be more difficult, in my view, to go to a breakdown, because the breakdown will have very deep implications. So what are the key contradictions on the monetary and fiscal dimension? Clearly, the public debt crisis, affecting particularly Italy and Greece. Greece now has 25% interest rates to pay on the emission of new bonds today, okay? 25% interest rates. The central bank is not buying this bond at a zero interest rate, so the Greek government has to pay 25% to this gentleman who is my banker, and then he sells the same bond to Draghi as a part of the QE, okay? So he gets a lot of money, and they have to pay 25% to him. So you can see how finance is concentrating all the benefits of the quantitative easing policy, and the Greek government is concentrating all the crazy costs that will be mounting on that. So paying the 25% interest rates means that basically in 4 years I have repaid the debt, but of course I will never accept that I have repaid the debt after 4 years only through the interest, and you will want my 100 after the 4 years again. So this is the case of Greece, and particularly in Italy, and therefore the only sensible thing is a debt restructuring. There is no other way to address this. By the way, interesting in the INET conference, one of the most interesting sessions with the Stiglitz and experts of debt was about how you do debt restructuring. The most dangerous debt situation is not Greece today, it's Puerto Rico. Puerto Rico, as you know, is a colony, it's not a state, it's not a state of the US, it's not an independent state. So the nature of the public debt of Puerto Rico is a complete mess, because it's not part of the US public debt, it's not a part of independent state debt, it's not private debt, and there are no rules. After the crazy ruling of the US court, which gave conceded to the vulture funds on Argentinian debt the right to be refunded. You know, there was an agreement after the Argentinian default with creditors taking a haircut, but a few creditors, the so-called vulture funds, collected outstanding debt at zero price, and now went to court claiming that they have to be reimbursed at face value without accepting the haircut. So all the financial world is terrified now by the fact that this ruling prevents any other agreement on default being made. because there will be always someone saying, I don't accept the haircut, I don't accept the agreement, and they want the full reimbursement of my credit. So there is a UN commission where Stiglitz is a member of, and a number of other initiatives, and they are desperately trying to arrange a feasible procedure, because these are concrete problems, okay? A feasible procedure whereby you can deal with the outstanding Argentinian problem, but also the Puerto Rican problems and other countries' problem. Of course, Greece will be another one also. Wherever you have a combination of public law and private law, sort of finding a common procedure for dealing with this. So we have a global crisis on how the public debt crisis can be arranged. We have a lot of private debt. By the way, as you know, Italy, if you sum private debt and public debt of Italy together on GDP, Italy is below European average, because we have had a lot of public debt, no taxation on financial wealth, and but luckily we don't have a lot of private debt. All northern European countries have had an incredible amount of growth of private debt for students going to university, for mortgages on houses, for sustaining consumption, and so on. And this is creating a huge problem in a lot of countries. But this is not much discussed about, because of course this is part of the reasonable way in which the market freedom operates. And clearly there is no discussion on the role of finance, no Tobin tax, no even Volcker, the former chair of the Fed, is in favor of a return to the division between investment banks and commercial banks, but nothing has been done to regulate finance. What is the topic at the core of the Greek political confrontation? It's not really a problem about debt, because all Greek debt is already in the hands of public authorities, the European Central Bank or European states. So it's control of the principles. The Greek Syriza government is being grilled by the European authorities because the principle that you cannot go out of the neoliberal agenda, you cannot break the neoliberal dogmas, is what is at stake. So the issue is the control of policy, the policy states. They cannot accept this type of policy space changes. Of course, this increases inequality. Clearly, interestingly, the UK vote yesterday, tells us that this is not a vote-winning issue. So they are voting again for the party with opened the neoliberal age and introduced extreme inequality in the country. But generally what we are saying is a huge polarization. If you look at industrial production, this will be the introduction to Giovanni's speech. I'll give you just these two figures to begin with. 1/4 of industrial production in the southern Europe has been lost since the crisis, while Germany and Austria have been recovering fully, and a lot of production has been moved into Poland. What is interesting is basically the rise of German-centered core of industrial production. These are data coming from the European Competitiveness Report and work by Landesman at VIV in Vienna. The concentration of industrial production is now in Europe, in Germany, and in its satellite, the Czech Republic, Slovakia, Poland, Hungary, and Austria. And we have Italy not far, because Italy, of course, is cut in two. The northeast can be easily integrated into the Bavarian model of industrial manufacturing system. And you have Greece, which has 9% of GDP coming out of manufacturing. Okay, after the crisis.
That is France.
And France also, because France has strength in services. Okay, so of course, but clearly the deindustrialization of all Southern Europe and some of the, well, France is clearly now part of Southern Europe in many respects, is again a very serious dynamics. So the power of Germany is really dangerous, 70 years after the end of the Second War today, Second World War, and the polarization with the southern periphery is really likely to be unsustainable. Very final point, the loss of manufacturing employment, this is the work of Valeria from her work, has been only in southern European countries. Okay? So the German empire, shall we call it that, has been able to increase its industrial employment, and the rest of the countries have been able to find new areas, services, finance, and so on. So the price in terms of employment out of the crisis have been paid by southern European countries. So the question is what should be done to avoid these aspects. Thank you.